also connect with Cameron Brandt, who is now joining in, Director of Research at EPFR Global. Thanks so much for taking time out, and just wanted to start off by getting a sense from you as to how you're looking at the trajectory that we've seen play out on Wall Street, and how you've read into the producer price index report that we have seen, what the expectation is now from the US Fed.
Well, what we've seen from a fund flow perspective is an enormous flood of money come in to US mandated funds since the beginning of November, really eclipsing pretty much every other fund group that we track. Not surprisingly, having stuffed nearly 450 billion into US equity, bond, and money market funds over the past 6 weeks, there's the rush is beginning to fade a little bit. Investors are kicking the tires on some of the themes that they felt were worth backing, especially in the wake of Donald Trump's victory in the presidential election. But I think that there was nothing in the recent inflation numbers that will deter the Fed from cutting rates, as is widely expected, by another 25 basis points. I think the bigger questions are quite how far they'll go next year. Certainly, we're starting to see an uptick in flows into U.S. inflation-protected bond funds and some other signs that investors are not as sanguine about where inflation will go in 2025.
Interesting. Cameron, yes, that major inflow into the United States since November, call it the Trump trade or whatever, has been really strong. But what do you make of the flows into India and the other emerging markets? Because we had started seeing very initial signs of the FII money coming back into India, but that's got fizzled out. Do you expect this, strength in the US flows or flows into US likely to continue, at least for the medium term?
I think for the short term, we're obviously getting to the end of the year here. People are unlikely, for the most part, to change direction too dramatically when they might be sort of stranded in a trade over the holiday period. But yes, we saw the same thing. There was, after a period of, for the most part, pretty modest outflows from India equity funds. They turned positive again last week, turned mildly negative again this week. But I think it's more a question of distraction rather than any major souring of enthusiasm for India's story. We had seen prior to outflows starting last month, something like 84, 85 straight weeks of net inflows into the dedicated India equity funds we track. And there was always at some point going to be at least a modest reversion towards the mean. The Sensex has delivered a lot of profits, which at least some people will choose to take. So I think it's sort of slightly on hold for India at the moment, but I certainly don't detect any sort of major souring of sentiment, certainly towards Indian equity.
I just wanted to understand that since you are highlighting that the fund flow is directed toward the US market, so wanted to get a sense that where exactly the funds are attracted to. Is it the bond market or the equity market is looking lucrative at this point in time? And next week, it's also going to be one of the major events that globally we all will be watching out for, and that's the US Fed meeting. So given that fact, what are the expectations that we are building in, and how both of these markets are expected to perform?
Well, certainly built in is another 25 basis points rate cut. That said, that's pretty well baked into short-term projections. We've seen more money come into U.S. equity funds recently, but U.S. bond funds have had a very steady year. They haven't haven't posted a weekly outflow since the year began. So there's certainly sort of demand both for the excitement generated by the ever ascending US equity indexes and the certainly perceived security and pretty decent yield, certainly in a recent history context, on offer from US debt.
And before we let you go, this year has also been marked with a steady stream of flows into the physical assets, gold, silver, and of course, the kind of moves that we have seen in dollar this year. What's the expectation as we head into 2025? Which asset class, to your mind, is going to be the one which will see the maximum flows come 2025?
That's a good question. I'd like to sort of circle back on the question of flows to physical assets. That has somewhat bypassed the mutual fund ETF channel. And though we've certainly seen some better inflows into dedicated gold funds recently, it really hasn't been at the levels you might expect, given the geopolitical uncertainty and sort of the persistence of inflation in many markets. What we are seeing that I think is worth noting is a pickup in flows, certainly in relative terms, if not absolute terms, into fund groups dedicated to asset classes that might ring alarm bells for anyone who remembers the great financial crisis. We're seeing an acceleration of flows into funds, synthetic funds, into collateralized loan obligation funds, into leveraged funds. So I'm less concerned at the moment about sort of absolute winners next year. I'm more about this uptick of flows into fund groups, which sort of suggests not just increased appetite, but perhaps almost desperation to get sort of the top cream off the current froth.
With this, we'll let you go on that and appreciate your time. Thank you so much for joining in, as well as help us understand that where the fund flow is moving right now, given the construct of the market. But with this, viewers, let's move.
If you like this video, then like, share and subscribe to ET Now.